Mike Tyson once said, everybody has a plan until they get punched in the mouth. And that's exactly what happened to growth investors over the past year. Everybody says they have a high risk tolerance until they get punched in the mouth. And then they think, well, wait, maybe my risk tolerance is as high as I thought it was. This video today, we're going to cover 10 dividend growth stocks. Now, these are stocks that I've gone through an extensive screener as well as a couple of my favorite picks. I recently bought a brand new DGIF. This is going to be a blend of DGIF. So DGIF means total growth. You're looking at stocks that give you growth in the dividend, but also growth in the share price that are accelerating growth. People get confused because they hear dividend growth. They think that's a stock that basically has a dividend that's growing. And really, when you think of old school DGI, dividend growth investing, they're focused, it's more of like retirement, passive income. You're focused mostly on the growth of the dividend, trying to outpace inflation and trying to increase your income each year if you're on a fixed income, if you're in retirement, or maybe you're using a passive income strategy. So DGIF is a term that we invented in Fired Up Wealth. Dividend growth investing for Fired. It's focused on total growth. I'm going to give you a blend. Most of these stocks are going to be in DGIF. There's also a couple that are higher dividend yield. Just a blend of overall dividend stocks that I think are good for a portfolio to give you diversity. Because you might have got punched to the mouth and you might be thinking to yourself, maybe I need to have a more diversification than I thought. Maybe I need to diversify and have some dividend stocks. I don't know what storms lie ahead and my risk tolerance isn't as high as I once thought it was. So let's get after it. Let's look at 10 dividend growth stocks that I think are attractive at these levels and lower. Let's get started. Now, this first one's Mastercard. Of course, a lot of these stocks have run from the bottom, but the low on this was actually $281 just last week, September 28th. It's at $302 now. Now, if you look at this, the short interest is next to zero. It is a little bit higher on the PE ratio, so it's a 29.44, and the dividend's lower, it's a 0.67%. This would classify as a DGIF type stock. Let's look down here at the chart here at $300. Now, this here is the pandemic low, March 2020. This is pre-pandemic. So when you go back to February of 2020, this was trading at $345 a share. It fell all the way down to almost $200 a share. And it didn't quite get back there. It was at 280. It's at 300 now. So if you look at this chart, you're still giving back, 3 years, depending on where you go on a chart. And you don't buy just because of that reason. You could also say the PE ratio is too high. But if you're buying this stock, you're dollar cost averaging, you're holding this for 5 and 10 years, this is one that will continue to do well. Mastercard, ticker MA. Now, this is a small cap. I've never talked about it on the channel before. It's a $3.3 billion small cap. P ratio and Fidelity is showing you 3.21. So this has been beat up pretty bad. Now, the low on this was actually October 5th, 2021. So a year ago, it was actually down to $29.87. And recently it got down closer to 35. It's now closer to 40 after about a 5% pop today. I'm looking at this. The dividend yield is a 0.897%, so about 0.9%. It's a small cap, has about 2.8% short interest. So this is a life insurance stock. It's kind of boring, but when I look at the screeners, I put through thousands and thousands of stocks in the screener, and only 8 of them actually showed up in the screener. And this is one of the stocks to take a look at. The ticker on this is AEL. Take a look. Now, this next one is a Fired Up Wealth favorite, and I've been in this one for many years. Microsoft, $248. It's still below $250. It got down to $232.73 just last week, again, September 30th. So a lot of these have ran. You have to be a little bit careful about chasing with FOMO. But if I look at a 5-year chart on something like Microsoft, this is still expensive, but it also was a $350 stock at its high. And it is still going back to basically, March of 2021 levels. It's one of those companies that can weather the storm. It's going to continue to do well. It's kind of a tech conglomerate, mega cap tech conglomerate. It's a $1.8 trillion mega cap. Now, this will have potential currency issues when you think of being a multinational and doing business in other countries. There could be some impact on earnings. The P ratio is around 25 right now, so that could get compressed. It could go lower. I think below $250 on Microsoft, dollar cost average as a long-term investor. When you think of Azure Cloud, you think of gaming, you think of all the different things they have going for them, even Teams, cybersecurity. Microsoft is a great one. It's really, again, like a tech conglomerate. And it does pay a nice dividend, a 1.13% dividend. This is another DGIF stock, ticker MSFT. Now, I've had people ask me about this one. This is Monolithic Power Systems, Inc. It's $395. The low, July 5th, $348. It's still a 54 P ratio. Again, all these stocks came in through a screener, a very intensive screener with lots of parameters, looking for growth metrics, looking for past performance and projected future performance. And this one was one of the strongest one on the list that came up. So we got 10 total stocks we're looking at. 8 came up in the screener, 2 I'm adding manually. Now this one does pay a less than 1% dividend, so it's a 0.79% dividend. So again, DGIF, it's a mid cap, medium cap, 17.64 billion. And it looks from a technical perspective that it likes to wash out close to that $350 range. Of course, it's closer to 400 now. But this is another one, again, going back to basically October 2020. It erased a couple years off. They're going to continue to do well. Now, this is going to be a semiconductor equipment company that I don't own. I've never covered it before. And you can kind of see what they do here. So development, marketing, and sale of semiconductor-based power electronic solutions for the computing and storage, automotive, industrial, communications, and consumer markets. So they're headquartered in Kirkland, Washington. Definitely take a look at this one, do some research on your own. You know, it's a $17 billion market cap, 3% short interest, 54P ratio. This is one of the more expensive ones we'll cover today. Ticker on this, MPWR. Check it out. Now, this one's come up a few different times from several of our members that are Motley Fool subscribers. I think this is a Motley Fool pick. And while we're on that topic, guys, this video is sponsored by the Motley Fool. If you want to see the 10 best stocks to buy now, visit fool.com/firedupwealth. A reminder, they don't tell me what videos to make, what stocks to cover. This is all my opinions, and they're a great sponsor that helps me bring content to you guys at no cost. So Old Dominion Freight Line Inc., ticker ODFL, 24.28P ratio. This is a 0.45% dividend. So again, this is not paying you a huge dividend because it's DGIF. So they're focused on the growth of the company. They have a low payout ratio. They have a low dividend. Short interest on this is 3.98%. It's a mid cap, $29.27 billion. And it did bottom out at 231.31 back May 19th, 2019. So it is a little bit off of that, trading right now around $272. Old Dominion Freight Line operates less than truckloads, so LTL motor carrier in the United States and North America. This is continuing to be a big thing when you think of trucking and you do some research in that. I do not own the stock. It's been around for a long time. It was founded in 1934, and it's actually headquartered in Thomasville, North Carolina. Check out Old Dominion Freight Line, ODFL. Now stay tuned because I'm going to share with you the stock that I added, the new DGIF stock that I added to my portfolio, and you're going to want to see that one. This next one on the list that came out on the screener is Charles Schwab. Now this is going to be in financial services. It's going to be a 24P ratio, which in my opinion is maybe a little bit expensive here. It was $59, but it came up on the screener as being very strong even at these prices. Dividend, this one's about 1.2%. It's a large cap, about $140 billion, less than 1% short interest. And of course, these guys, together with subsidiaries, provides wealth management, security, brokerage, banking, asset management, and so on. So they do everything from ETFs to private managing, you name it. This is one of those financial services companies that's quite large. Charles Schwab, ticker is SCHW. And that brings us to the love-hate relationship of Taiwan Semiconductor, ticker TSM. Now, this is going to be an ADR. There's, of course, the Chinese risk, but this trading at a 14P ratio. This does have a monopoly. When you think about semiconductors, you've got fabless semiconductors. So you think of the companies that design, and then someone has to manufacture. And that's called a foundry. And Taiwan Semiconductor really has a monopoly, especially when you think of the small nanometers. They have a monopoly on those small, those high technology chips. Of course, the risk is the whole Chinese-Taiwan drama. This doesn't have much short interest at all, 0.43%. It pays a solid 2.66% dividend, 14P ratio. It has to be on the list because it shows up on the screener and it's a solid company. I don't own this one either, but I do think it's a solid pick. It's on my top 10 semiconductor stocks list. Taiwan Semiconductor, ticker TSM. Now this next one is one of my favorite higher yield type stocks. This is a semiconductor company, but they're also trying to acquire VMware to get more into cloud services. So this one is a semiconductor company. They also have CA Tech, so they do software already, and they're trying to broaden that more, diversify. So Broadcom, ticker AVGO. Now this one is about a 20P ratio. Pays you a solid 3.59% dividend yield. It's almost 3.6% dividend yield. The short interest is 1.5%. Mega cap, $185 billion market cap. You can see on a 5-year chart, 475, it bottomed out about 443.64 just last week. A lot of semiconductors were beaten down really bad. I've been saying for a while, I like this one under $500. I said 465 and 450 were good targets. Back at 475, I still like this thing at 475 and under dollar cost average, especially with the solid 3.6% dividend yield. Check out Broadcom, ticker AVGO. The thing is that stocks bottom at different times. And some of the stocks we were buying in May and June, they're up significantly from their lows back in May and June. And now we are, $196. It would have been a great opportunity at 166. I still like this company. I still like this stock at this price range. 21.44 P ratio. Pays you just under 2% dividend, 1.9%. Short interest is 3.87%. Mid cap, 21.55 billion. If I look at a 5-year chart, the stock has done very well. It's pulled back. You can see the low here back in May, $166. This is one of those I've covered on the channel before. I like it a lot because a lot of the towns that these are located in, it's brick and mortar, but it's not just Tractor Supply parts. It's kind of like a mix between a Home Depot and an Ace Hardware. They sell everything from tools, hardware, clothing. They sell supplies for different animals, they have pet supplies, they have a veterinarian side of their business. They're going to continue to grow and do well. I think if we do see a recessionary type environment, this is one of those companies that's retail focused that will still continue to do well. Number one, their locations. A lot of the towns they're in are smaller towns where there's not a lot of options of where to go. They're also in third tier suburbs where you can say live in Minneapolis and you can go to a Tractor Supply company. If you're on the outside of the suburbs, the rural people can also come in. But they're not like in the downtown areas, so they're not going to cater like a Home Depot would or something like that, closer to the inner city in those suburbs. They're going to be in that third tier suburbs, a little further out, so suburbs can still get to them, but those rural consumers can get to them very easily. And then there's a lot of places like small communities with a couple thousand people, where there's Tractor Supply companies. And like I said earlier, there's not a lot of options to go elsewhere. So I like this one. I like the management team a lot. I followed this stock for a couple of years. I've been buying it since I think 2020, 2021, continuing to dollar cost average if it goes the right price points. Right now below $200, still attractive, especially if it pulls back. Take a look at Tractor Supply Company, TSCO. All right, so this is the 10th stock pick on the list. It's my newest addition to my portfolio. It's a DGIF stock. When it got below $200, I nibbled a little bit, have a starter position. I like this one below $200. It pays you about a 0.75% dividend yield. The last earnings, 40% revenue growth. They're really starting to accelerate. They've really started to grow. They've acquired some different locations. They've also grown a lot of new stores. There's been several new stores popping up around my house. If you look at this stock, it's in 16 different states. There's 2,400 locations. Third largest convenience store and fifth largest pizza chain business in the United States. And you say, so what? Why do I care? I've been following the stock for a couple years, and I go to these stores. I like the stores. I think that people are going to continue to go, whether they're, the economy is good, bad, or indifferent. So if we get into a recessionary type period, this is one that I think will hold up pretty well. I also like the fact that they're vertically integrated in the sense they haul 75% of their fuel gallons sold. They're located in that central area with 16 states, and they really do a good job of distributing to allow themselves to sell their gas at lower prices and still make more margin than a lot of their competitors. And so I like that part of their business a lot. This is not going to be a high growth stock or anything. It kind of barely fits in the DGIF because you need 10% or more compound annual growth rate, and they're at 8 to 10%. You can see 345 additional new stores acquired by FY 2023. So they're going to continue to grow and to add more stores. Margin expansion, they're doing more with food. They've got their own private label. Well, I could spend an hour just in the stock, but we don't have time for this video. This one is CASY's. The ticker is CASY. If you like this video, guys, make sure to drop a comment, give me a like, make sure you subscribe, click that bell and notifications if you're new to the channel. Appreciate your time and attention. Hope you have a great rest of your day. Take care.